It's Jack Hartsock, market strategist, ACI Wealth Advisors, Process Portfolios. Another Markets in Minutes update. Today, it's going to be the S&P 10-year Treasury and Commodities. If you'd like to learn a little bit more about my firm or I, just visit jackhartsock.com/about or aciwealth.com/about. Let's take a quick look at the S&P from a valuation basis. What we've got here with this red line, that's the average price earnings ratio, which is a way a lot of people determine whether the stock market is at fair value, undervalued, or overvalued. So this is the 10-year average of the equal weighted price earnings ratio. The blue line is the current price earnings ratio. And what we're seeing here is that at the moment the S&P is well above the average of the 10-year price earnings ratio. It's actually more expensive than it's been about 80% of the time in the last 10 years. That's not necessarily a horrible thing, but it does say that we do need earnings to continue to strengthen, or we could see what's called price earnings compression. So let me explain what that is very quickly. When the current price earnings ratio is below the historical average, as it is here, that sometimes results in what's known as price earnings expansion. So that means the price goes higher. And then when you're above it, conversely, the opposite can happen. So if you're in a situation where the price earnings ratio is well above the historical average and you have falling earnings, then you get, or stable earnings, then you can get what's called price earnings compression, and that happens when the price falls. So something to keep in mind in the chart I'm going to show you here in a minute. So what we've got here is SPY, which is a proxy for the S&P 500. And much as I said earlier in the last time we reviewed the S&P, I was expecting several weeks, possibly even a couple of months of consolidation where the S&P didn't do a heck of a lot. Maybe went up a little, down a little, but stayed in a reasonably narrow range for an extended period of time. Consolidation is necessary before something can move higher most of the time, or you have to have a correction or a pullback. So what we're seeing in the S&P at the moment is that it's doing exactly what I had expected back in mid-December. We'll see if that continues to hold true. I think we probably need another month or two of consolidation, or some continued consolidation and maybe a correction of some kind. Now, if you think back to the historical average price earnings ratio of the S&P, to give you an idea where that would take us, look at these crosshairs over the right of the screen that I'm circling around. If we were to fall all the way back to the average price earnings ratio or fair value for the S&P, that would take us all the way down here into the 175, 180, 185 range. So that would be a correction between 17, 21%, something in that range. I do not think that we will see a correction of that magnitude when we are in a growing earnings environment. So that's kind of my take on what's happening. If we do see a 5, 6, 7, 10% dip in the S&P at this point with growing earnings, I would consider that a buying opportunity. Let's move ahead into bonds, and that is, there we go. Now what we're seeing here is the yield on the 10-year bond. Most of you may know this at this point, but when you see the yield rise, as you see these green bars coming up, well, that happens, the bond principal price, or the bond price, is falling. Bond yields and bond price have an inverse relationship, so that just means they do the opposite. And you may recall that at the last bond update, I was expecting yields to fall a little bit, and they kind of kept going a little, but then they started to fall, and now they're trying to rise again. I would kind of expect that rates are going to fall a little more before they begin a more sustainable rise. I would seriously consider, if you have bonds that mature in, say, more than 4 or 5 years, seriously consider whether those bonds truly belong in your portfolio or not at this point, because there's more risks in bonds than we've probably seen in a generation. And we'll see. If you get a pullback in this 10-year to the maybe 2% range, 2.1, 2.2, you really need to do some thinking about what these bonds are doing in your portfolio if you have longer dated bonds. If you're on a 1-year bond, 2-year bond, not quite as important. If you've got 7, 8, 9, 10-year maturities, you need to do some thinking. Let's move on to commodities. Here we have oil. Here's the weekly. Now, as I said earlier in my last update, I'm kind of expecting oil to be relatively stable this year. And I thought maybe it would move between 45 or 50 and 60 or 65. And so far for the year, that's what's happening. I don't see that there's a catalyst to really move it either way from either a fundamental basis in terms of supply and demand or from a technical basis just in terms of what this chart may or may not be saying. I just don't see it moving a great deal between this range because when that does happen, it's going to kind of give one side or the other an advantage in the dynamic, OPEC versus non-OPEC producers, and I just don't see that happening. They're going to be at odds and try to cancel each other's influence out. So oil's probably going to be stable for most of the year in that range. That's very good for the U.S. consumer. It provides a tailwind. Let's take a quick look at copper, and then I'll wrap this up. Now, copper is often considered a proxy for economic activity, specifically industrial activity, and we saw a big run up here after Trump won, and on the belief that he would vastly increase infrastructure spending. And what we've seen is it kind of pulled back from some of that initial exuberance, and then kind of rose again, and now it's kind of falling again. I would not be surprised to see this fall maybe a little bit more than it did previously once we get a lot of clarity and details on what this infrastructure spending is actually going to look like. Regardless, I think copper has moved into at least a near-term uptrend. I would see it, maybe moving between 2.3, 2.4, maybe up as high as 3 in the near term. Not an investment recommendation, just discussing what the current setup is, but I think copper has probably found a bottom, at least in the near to intermediate term. So, with that, I'm going to wrap this up. Hope everybody has enjoyed this update. If you have any questions, there's my email. I'm happy to answer any questions from anywhere around the country. And my clients, of course, have my office number. Feel free to call. And with that, I'm going to wrap this up, show the mandatory disclosures, and I'll see you next time.